focus seems to be on keeping gains to date amongst investors on the NSE up so far. How are you reading market movements at this stage of the game and the kind of investor activity we're seeing from that end, where investors have been pretty tempered in their approach?
Morning, Alishia. Yes, we really expect at this stage for investors to be focused really on trying to maintain the gains they've made year to date. The NSE has been up just around 18.5% year to date. The NSE 30 up 25%. And I think in terms of major catalysts for the market, we've seen as much as we are going to see for the year. The exception, of course, is if we see further news flow on the banking sector and AMCON, notes on M&A transactions, specific transactions, or confirmation that the AMCON has begun to buy affected assets. Now, given that we haven't been notified that AMCON has issued any of the bonds that it intends to issue, then I don't think that that's going to happen this week, for instance. And unless that happens, I think that it's a case of maintaining gains as investors start to wind down.
Let's take a look at some of the companies that have been making news headlines. Flour Mills is in the process of a bond issue. One would assume, though, that pricing has got to be key here, a very big issue. What are your forecasts on that front?
Well, I mean, I think that, as we know, yields have begun to rise in this market, and for a corporate bond, one would expect that from a liquidity point of view, it would not have the depth that a federal government bond will have, and in theory there should be a greater yield to compensate investors for that, and of course just the fact that it is not the sovereign. So we would expect Flour Mills, for the discerning investor, we would expect them to require a spread, outside of where the 5-year is trading, which is around 12.5%. Now, of course, there is a sort of a diversity element there, in that there aren't that many corporate bonds out there, and for those that are investing in fixed income that want to spread the categories of risk that they're taking, then Flour Mills is welcome. But I think the bigger point really is that the issue is unlikely to be particularly liquid, and it ought to trade really slightly wider than the sovereign as a result of that. So we would look to see something north of 12%, to be honest, for it to be attractive.
You mentioned the banking sector earlier, and how the market is waiting for specific announcements to act as a catalyst for further movement within that space specifically. How are you treating the banking sector right now? Are you merely holding positions, or are you stepping back and outside of that sector at this stage?
No, not stepping outside at all. We've been recommending that investors basically position themselves in names that we believe are going to be able to negotiate all of the events that we expect over the next 12 months successfully, regardless of any choppiness that we see in the market in the interim. I think some investors, for instance, have been distracted by the affected banks and have tried to speculate on those stocks. But our recommendation has always been that when you have price to books relatively modest among the healthy banks, there is no merit, or there's little wisdom in playing in the affected bank space. So we still like, among the tier 1 banks, for the longer term, we still like GT and First Bank, and among the tier 2 names, we still like Sky and Diamond Bank. Those names still offer a reasonable upside, we feel, and I think that I think investors are starting to increasingly understand the Diamond Bank story, and we're seeing increased interest in the name, both domestically and internationally. And I think similarly for Sky Bank, certainly we've had more inquiries and a greater sense of kind of corporate access requests for those names, as people begin to look a bit more closely at the names that they feel are going to be able to negotiate the medium term. And so we would still recommend that investors position themselves in light of that.
Rele, I've come across a market rumor, strong indications emerging at the weekend that troubled Societe Generale Bank will commence business in the first quarter of next year, as negotiations with new investors have reached the final stage. Have you heard any rumorings along those lines?
Yes, I saw some news clippings to that effect. I mean, I think that obviously there is no, I don't have any details or anything substantive to report on or to reference, but I would think that given that we are in a situation where overall, the banking sector has seen tepid loan growth, there's still a fair amount to do in terms of positioning itself on a firm footing for 2011. There's still a lot of event risk within the sector. We still expect transactions to occur. I think it will be pretty difficult for a bank that has been out of the market for as long as SocGen to be able to really steal a march in 2011. You know, there are guys that are healthy banks right now that are poised to try and gain significant momentum in 2011, and I think it might be tough for SocGen to come against those kind of names having been out of action for so long. But let's see.
Well, that's a story we'll definitely be tracking as the details emerge and unfold on that front, where your recommendation has been for investors to exit a more speculative position and to hold more resilient defensive names as we move into 2011. Outside of the banking arena, some of the stocks that are on your radar screen right now?
Okay, well, outside of the banks, we like the food producers among the consumers. The valuations we think are attractive. There's been some anxiety, we think, because investors are concerned about input costs, input prices, particularly wheat and sugar. But we still like Dangote flour, we like flour mills, and we like Dangote sugar. Those guys are trading at PEs of between 9 and 10, 2011 PE versus the sector average in the mid-teens. So I think that we still see significant value in those names, and we would recommend that investors position themselves in those names. Owando is another name that we like, we continue to like. Even though there's been some delay on the passing of the PIB, or there's some uncertainty as to when that is going to materialize, I think that Owando is one of the few players that is in a position to participate in upstream assets, and I think that it is serious about so doing, and that will change the margin mix and the earning capacity of that company over the medium term. So those are some of the names that we would recommend investors take positions in as we move through to maybe choppier periods at the end of the year.